This is the penultimate week of lectures, and we will discuss the experience of developing countries in terms of trade and its experiences of growth, crisis, and reform. The textbook chapter is chapter 22. You will see the main focus is on Latin America in this chapter, but it also mentions the Asian experience. One reason for the exclusion of Africa is that Africa has only entered into the global markets more recently. However, I will add some facts and data on South Africa. I won't spend too much time on the outline, but as you will see, we will end at full circle, coming back to geography in the last section. Geography was a big part of the gravity model discussed in the first part of the course. With regards to international trade, developing countries have gone through various stages. We will discuss some of these experiences today. Remember the African experience that we saw during the discussion in week 7 on trade policy and developing regions. One crisis that not only affected developing countries, but also the developed world, not covered today, is the Great Recession of 2007 to 2009. You can read more on this experience in the chapter on European development. Developing countries have also had varying degrees of success and failure with regards to dealing with the crisis. This week, we will use the Asian and Latin American experiences to illustrate this. The one problem with crises experienced in developing countries is that given the level of poverty and vulnerability of individuals in these countries, economic slumps not only threaten economic growth, but also the political and social cohesion of the country. There are mainly 4 learning outcomes for this week. First, after reading through these notes, slides, and the chapter, you should be able to differentiate between the unequal distribution of income around the globe and ascribe some of the causes of these varying incomes. Second, we will investigate the position of developing countries in the world capital markets and discuss the problem of default faced by these countries. You must be able to recount and revise the recent history of developing countries' currency crises and financial crises faced by these countries. Finally, you should be able to assess the proposed measures and enhance poorer countries' gain from participation in the world markets. The basic problem faced by developing countries is poverty. Most economists would agree that the best way to deal with poverty is through economic growth or growing the size of the pie. This is exacerbated by the lack of quality or the quality of factors of production in poorer countries, especially the lack of capital and skilled labor. One of the main theories of growth in economics is the Solow model that uses both these as important inputs for growth. Other problems, such as political instability, insecure property rights, and misguided economic policies, magnify these problems and discourage investments in developing countries. The easiest, but by no means the only way to differentiate between countries are by per capita level of income. This uses GDP, and as you should be aware, GDP as a measurement comes with its own set of problems. Other measures that are more and more used include the Human Development Indices and Happiness Index. Amartya Sen pioneered thinking of happiness and economic development. When using the level of income of countries, countries are usually divided into 4 categories: low-income countries, middle-income countries, upper-middle-income countries, and high-income countries. South Africa is currently categorized as an upper-middle-income country. This is given the relatively high per capita income relative to other countries, but also infrastructure development. Remember the problems of income per capita if it is in a country like South Africa with high income inequality. These categories are also not fixed, but when countries experience economic growth, they can move to a higher category, or when it experiences economic decline, it can fall back into lower categories. Developing countries are usually in the bottom 3 categories of these listings. The first table in this chapter relates to the distinction of countries per income group, but as I mentioned before, it also adds another measure, namely life expectancy, to illustrate the differences in economies. If you are interested in more of these measures, continue with development economics and international trade in honors. As you can see, the table uses World Bank data. The World Bank data are easily accessible and has a variety of measures for you to look at. Further, you will see that there is a positive correlation between the level of income and life expectancy. That means that the level of income increases, life expectancy is also expected to increase. The income in low-income countries is only $523 per capita, while it is over $30,000 in high-income countries. Similarly, in low-income countries, average life expectancy is about 60 years of age, while this increases to about 83 years of age in high-income countries. To compare South Africa, and before we move on to the question of changes over time, South Africa, you can see, has seen a growth in per capita income since 1960, and life expectancy on this slide. South Africa's real GDP per capita in 1960 was around $450, while it increased to $6,000 in 2007. Life expectancy in South Africa shows a different picture to other countries' experiences, for one specific reason, the AIDS pandemic. While it increased from 48 years in 1960 to 63 years of age in 1991, the AIDS pandemic in the country massively reduced life expectancy again. This meant that in 2007, average life expectancy in South Africa was only 54 years of age. It is, however, on an upward trajectory. In this section will briefly look at the question of whether or not there has been convergence among income levels of countries. The short answer is, it depends on the countries you are comparing. One industrialized country that has shown convergence with others is Ireland. Look at Ireland compared to the United States from this table. In 1960, Ireland's per capita output was less than $7,000, while the United States stood at almost $16,000. That's a difference of almost $9,000. In 2007, this picture has significantly changed when the United States stood at $43,000 and Ireland at $42,000, a difference of only $1,000. The reason for this convergence is the annual growth rates of the countries. In the United States, it was 2.1%, while in Ireland it was almost 4% between 1960 and 2007. Remember, the growth rates are also affected by business cycle. These average growth rates are closer to the long-term growth path of the country and ignores fluctuations around this path. In this table, you can see the growth in Asian countries are much higher than other regions in the world between 1960 and 2007. This is the reason for their convergence with the rest of the world in terms of per capita income. This figure shows South Africa's annual GDP growth rates since 1960 to 2007. While the average is 3%, you see there have been large fluctuations, and South Africa has been unable to manage continued growth over long periods of time. These comparisons illustrate the vast differences in long-term growth of countries and the trajectory that this places the countries on. To converge, the base from which countries grow are also important. African countries grow from less than $600 in 1960s, but by this time industrialized countries' income was over $10,000. This kind of long-term thinking is growing in significance and is the topic of economic history. If a country can grow at 3% per year for an extended period of time, real income per capita would double every generation. There is a rule of thumb you can use here to test how long it will take a country to double income per capita. The rule says you take 72 and divide it by the growth rate. For example, 72 divided by 3 is 24, a generation. To do this for South Africa, you might be surprised. Again, economic growth is the best way to grow the economic pie and alleviate poverty. These growth rates are also caused by various and differing economic and political features of developing countries. These in turn affect how these countries respond to changes in the world and internal pressures. Remember from first year economics what the structural feature of an economy is. The structural features involve how sectors change in the economy, but also the role of the government, its inflation trends, and capital account trends. Again, think of the Keynesian model and the inputs in this and relate it back to these questions. Further than simply GDP per capita, there are some common features of developing countries. A country might have some or all of these features. Developing countries have a history of extensive government control in various industries, like Eskom in South Africa. There is also a history of financial transactions and a high share of GDP government spending as GNP. Many developing countries have a history of high inflation. While this is not the case in South Africa, Zimbabwe, our next door neighbor, is a key example of this problem. Often, as to avoid problems of tax evasion, governments print money that causes inflation problems, called signerage by some economists. Again, less of a problem in South Africa due to our very strong banking institutions and laws, but developing countries often face problems in financial markets. This includes patronage, government interference, and fraud. Remember the trilemma of open economies. Developing countries often choose to fix or manage their currencies on the world exchange market. One way to do this is to limit or control capital movements. Another aspect of developing countries that we have already come across in this course is agricultural commodities and natural resources' role in the economy. South Africa relies on gold and more recently platinum, but we have limited supply of these. By some estimates, we have 50 years of gold left and 200 of platinum. Should we still plan our economic growth with these trajectories in mind? The economic discussion on this reliance is often referred to as the resource curse. Finally, a common feature in developing countries is attempts to circumvent government controls, taxes, and regulations. This results in corruption and bribery. In the textbook, you will see a negative correlation between corruption and the input per capita. I will leave this here for this video and continue with the problem of debt in developing countries in the next video.